Good afternoon, everyone. Welcome to our 5th annual Investment Manager webinar. We're thrilled to have you all here today with us. Our relationships with you all, our partners in the asset management community, is very important to us. And our goal for today is to provide you with an update on NEPC, our investment team, and how we underwrite managers. I'm Forde. I'm a partner of the firm and lead our Marketable Equity investment team. I'm joined today by Nina Petkova. She's a senior investment director who oversees our global equity research efforts. Today, Nina is going to provide us with an in-depth look into our investment process and highlight a few key initiatives for us here at NEPC. I'm also joined by Kevin Lau-Hansen, who's a principal and heads up our Operational Due Diligence team. Kevin's going to highlight the evolution of his group, the work that they do, and how it might impact you all. With that said, we're going to go ahead and kick things off with a brief business update on NEPC. We really remain a privately held company with 50 partners whose remit is really to focus on maintaining and then also growing our business. Our continued independence has really allowed us to put our clients first. To avoid those conflicts of interest that other peers have, really 100% of our revenue comes from traditional advisory relationships as well as discretionary or OCIO services. We don't get paid at all by investment managers in any capacity. On top of that, we have 365 employees who operate across 8 different offices, including our new London office, which has been a great addition. It's really allowed us to better serve clients globally and then also partner better with asset managers outside of the US. We opened up that London office in the fall of 2023, thanks to the leadership of Larissa Davey and Andrew Pedersen, both of whom are principals at the firm within our investment group. We remain very fortunate to be one of the world's largest consulting firms with over $1.7 trillion in assets under advisement, and that's across roughly 400 clients. These clients are serviced by our consulting group. Our consulting team consists of 6 different practice groups, which you can see here: corporate defined benefit plans, defined contribution within that corporate practice, endowments and foundations, healthcare, private wealth, public pension plans, as well as Taft-Hartley. This structure and the ability for us to work across these different client types has really been a huge help for our business. Unlike a lot of our peers who might focus on 1 or 2 different client areas, our source of revenue is really diversified across each of these areas and allows our business to remain stable even during really turbulent times. On our client-facing side, consulting teams are organized by these client groups. That's a little bit different on the research side, where we're organized by beta, and we'll provide you a little bit more context and detail on that in a few slides. But ultimately, our goal as a business for you all and for our clients is to be big but feel small. And what we mean by that is we want to bring different resources or size and scale to our partners, but we also want to offer each client a customized service, really based off of their needs, their objectives, and the challenges that they face. So, speaking of challenges, each year, Greenwich Associates conducts a survey of institutional investors and highlights some of the biggest challenges that they've faced and how that might have changed year over year. In this year's survey, asset allocation and market volatility really remain the primary challenges for institutional investors. And that's pretty much been the same regardless of the year. If we think all the way back to 2022, we saw challenged equity returns. We saw the start of the Fed starting to hike rates and higher inflation. But as equity markets rebounded pretty meaningfully in 23 and 24, you saw less concerns from this cohort related to market volatility and inflation. So here you can see the percentage of institutional clients who noted these challenges move steadily lower. With that said, we did see an increase in challenges related to asset allocation and investors really grappling with decisions around where and how to allocate capital. Obviously, the world has changed a lot since the completion of this survey, and I can tell you if we took that survey today, based on our interactions with clients, some of the main areas of focus would be related to growing their private markets book, 1. 2, challenges related to liquidity, seeing lower distributions from private market GPs. 3, whether fixed income alone is an appropriate diversifier or hedge versus equity drawdowns. And then lastly, assessing some of their public market manager performance during a really turbulent time in Q1 and in April. Some of these challenges dovetail pretty nicely into the next slide, where we look at the expected asset allocation shifts over the next 3 years from institutional investors. Maybe just a few big takeaways from the results here. 1, on a net basis, within both US and non-US equities, allocators plan on reducing that exposure, really regardless of whether it's an active or passive implementation. 2, many are trimming their equity allocations in favor of their private market book, particularly within private equity and private debt. This is certainly a trend that we've seen in spades. With that said, we do think investors remain pretty wary about the size of their private exposure and just the amount of capital being deployed in the space. And then lastly, for the first time in a long time, fixed income allocations are increasing with higher yields. Personally, our fixed income assumptions at NEPC have ticked higher. And as a result, you're seeing more traditional fixed income allocations being back in vogue. In order to meet these ever-evolving challenges from our clients, in order to remain one of the best consulting firms in the industry, we have to continue leveraging and developing our assets. And at NEPC, our biggest asset is our people. So with that, I wanted to give you and highlight our incredible investment team and give you an inside look into our structure and coverage areas. This slide shows our investment leadership group and is led by our Chief Investment Officer, Tim McCusker. Our top-down and our macro views are developed by Phil Nelson and his group. And then we also have our investment strategy team, who is responsible for implementation and manager research, and that is led by Sarah Samuels. Our investment strategy team really interacts the most with the manager community, as we're responsible for curating our focus placement list. And our focus placement list, or FPL, is really our highest conviction ideas that go through our full due diligence process. This group is generally structured by beta groups across both public and private markets. For example, Dilari Pancholi leads our credit and diversifying strategies group. Josh Beers oversees private equity. Oliver Fadley leads our private debt efforts. Matt Ritter leads real estate and real assets. And then, as I noted before, you'll hear in a few minutes from Kevin Lau-Hansen, who leads our operational due diligence team. Maybe one additional important thing to highlight here that doesn't jump out on the page is that each of the team leads within our investment strategy group is a partner or principal at the firm. We believe this will ensure greater stability across our leadership ranks and also serve as a reflection of how valued our investment talent is here at NEPC. This next page, which I won't dwell on, goes a little bit deeper into our investment strategy group. We have over 40 dedicated investment manager research folks who really own their specific asset class and, again, curate our focus placement list. Part of our work is also generating thought leadership and really sharing our investment insight with folks outside of the walls of NEPC. So we've been really busy so far this year curating talent and thought leadership as well. You can see some of the research that we've done so far this year, including a piece from the equity group on extension strategies, Delari Pancholi and her team highlighting the role that diversifying strategies should play. Sarah Samuels in the private markets group talking about continuation vehicles, which has certainly been topical. And then earlier this year, our annual letter from our asset allocation group. Each of these pieces can be found on nepc.com, and it's a good way to stay informed. Maybe to wrap up this section, I know many of you, all of you on the webinar are really here to better understand how to work with NEPC. And so we also wanted to leave you with 4 things to that end. 1, stay on top of our views on nepc.com. This is where you can see the thought leadership and get a sense of the areas that we might be highlighting, the areas that we think are high conviction, and then also the areas that we might be pivoting away from. 2, bring your best ideas forward. We're really focused more on quality, not the quantity of ideas that you bring to us. Time is a really precious asset for everybody, and our job is not to boil the ocean, but to be focused in the names that we underwrite. So come prepared with your highest conviction ideas as opposed to a menu of offerings. 3, be prepared to offer highly competitive pricing. It's part of our job to negotiate fees and terms on behalf of our clients. We view that as part of our value add and certainly take that seriously in conversations and underwriting of our strategies. And then lastly, be willing to take no for an answer. We have a focus placement list, which is really designed to be exactly that. It's focused, so we can't rate and approve everybody, but we do take it as part of our remit to engage with folks, but again, be willing to take no as an answer or potentially next time as an answer. So I hope that was a helpful business update and an overview of our team. And with that, I will turn things over to Nina Petkova to hopefully dive into our investment process.
Thanks, Phil, and good afternoon, everyone. As Will noted, we value your partnership and the time today to get to know NEPC. We know that the more we can share, the better partners we can be. And so key pieces of information and feedback that we at NEPC can provide an investment manager community really include, on one side, what criteria we focus on when evaluating managers and strategies. So that's the first item I will cover. And secondly, I'll provide a summary of our search activity that can sort of point to key areas of focus for clients. So first, on the manager research process, I want to reiterate our goal before we dive into the page. Our goal is to identify innovative and high quality investment strategies that not only meet but exceed our clients' objectives. So how do we go about it? We start with robust idea sourcing that may differ across asset classes, starting from conferences, network channels to universe screening. It incorporates vigorous and proprietary quantitative analysis and marry that with a qualitative assessment. And trust me when I say that it is those softer topics where we're able to gain insights and truly capture inflection points. We use a committee structure when making decisions that ensures fair and unbiased approval process. And the work doesn't stop there. We monitor investments, and that is an integral component of our process. If there are 2 things that you take away today regarding our investment process, and this page exhibits that perfectly, I hope that you get, 1, that we apply second level thinking. As the curious investors that we are, we dig deeper and think differently than the crowd. And second, we spend a lot of time on alignment of incentives. That's tied into the business strategy of an organization around launching and closing strategies, viability and profitability projections, and those can be different expectations on the publicly traded side versus a privately owned organization, and also succession planning, which we believe is a multi-year process, and investors really need to be provided plenty of visibility. So I sort of covered the far right side. If I was to go one step deeper on the quantitative side, without giving away any of the secret sauce, you all should know that in our quant work, we focus on trying to assess true skill versus luck. We do that in a few proprietary ways. And ultimately, we're trying to boil down and predict the likelihood of sustainable excess returns into the future. We try to identify a manager's edge and confirm if it's sustainable, or can it be arbitraged the way. On the next slide, you see a top-line view of our investment framework. There's obviously a lot you're not seeing behind the curtain. It's broadly organized across 5 categories and ultimates in a cumulative score. Next, you will see one other segment of our investment framework on the following page that includes an investment rating, which ranges 1 through 5. 1 and 2 rated strategies is what we refer to as focused placement list or FPL. They represent best ideas. They're few and far in between. Due diligence ratings of 4 or a 5 represent an unfavorable view and, signify that we have significant concerns there. So you're unlikely to see us advertise those strategies. As part of this ongoing monitoring, we also utilize a slightly different lever. We're calling it due diligence status. And that's used to communicate our assessment on, a newly emerging information, more relevant for existing investors in that strategy or invested in the firm. No action is the sort of less concerning version of that, and it goes down the priority list from watch, hold, client review, all the way to a terminate recommendation. So I'm going to end here on our investment process and now switching gear to manager search activity next. What areas were most popular for searches and reviews over 2024? On the slide here, you see total searches and reviews. And if I had to define what a client review is, you should know that it's an analysis of a segment of the portfolio that evaluates, an existing mix of strategies and or also profiles alternative options. So could be a reflection of an annual revisit. Some of our clients have that structure. And you can assume that it is very similar to a search, but one step less formal. So across the board in 2024, we have conducted 963 searches and reviews, representing more than 48 billion of assets under advisement. I will also say that every client situation is different, and so it's really hard to tell in aggregate and dissect that information. Having said all that, search activity has been higher across the marketable equities segment relative to prior years, and searches were predominantly focused on active strategies, which isn't surprising given market volatility and uncertainty as a backdrop. The net increases in searches relative to last year were in US spaces. The aggregate across large cap, small cap, and mid cap equities, also all cap equities, they more than doubled. In some cases, clients doubled down on basics, ensuring their highest caliber relationship and really reaffirming the role in a portfolio. We've seen also a little bit of an uptick in large cap value searches in 2024, and as you can imagine, that helped mitigate the concentration risk associated with some of the mega cap names in the US. I was going through information on our search activity in 2024, and noted, the uptick in activity relative to US spaces. But also on the other hand, we've seen a consistently robust number of searches outside of the US and international, global, and emerging markets relative to prior years. Global equity continues to be a key area for active managers, given the broad opportunity set, the high dispersion between countries. We also saw activity on the fixed income side relative to prior years. Will noted that as well. It's once again an interesting space. Higher yields certainly allow bonds to play a more prominent role in diversified portfolios. The experience on the alternative side has been interesting as well. We have certainly seen activity increase last year. Clients are broadly in search of capturing higher return premium. You've heard this before. Investors are also increasingly turning to real assets like real estate infrastructure to diversify their portfolios and to help hedge against inflation. I have to admit that on the private equity and private debt side, part of the numerics here are a function of fundraising cyclicity, and so we saw something similar in 2020. More commitments, heavy years. So I'll stop here, and if we quickly go to the next page, I tried to extrapolate some of the major themes. Once again, we definitely didn't cover all the dynamics, but we hope this information is helpful. We've included a summary of our historic search activity for those of you who are joining this webinar for the first time, and so hope you find this information helpful. And lastly, I will preview some of our key initiatives. So if we flip one or two pages forward, you will hear us mention this again. We're focusing on operational transformation. Key resource for us there is Backstop, our partner. We use Backstop as a research repository. It's truly an integral part of our client delivery model. But as with any database, the power in it is in the content and in the data that it hosts. And so manager materials are truly integral. So we ask for continued support through updating eVestment, making sure that it's reflective of the most current information, also supplying additional GDQs and responding promptly to prompts through Diligence Vault as we use it for communication with managers. And here I want to say thank you all for the partnership and the assistance with that. And now I want to welcome my colleague, Kevin Lau-Hansen, principal at NEPC and head of our operational due diligence group, who will take you through our operational due diligence spotlight.
I'm Kevin Lau-Hansen, the head of operational due diligence here at NEPC, and I'm a principal. I lead a small but growing team of 4 individuals. That includes Charlie Tilden, who has been with NEPC since 2022, Eric Bruch, who joined us just recently in April 2025, and Brenna McGeady, who has been here since 2023. The standard initial ODD underwriting process follows the steps that are listed here. It is typically requested either by a client who wants a review of a particular strategy, or by the investment due diligence team once they have reached a certain stage in their process. We will always kick off the process with a review of key documents, including offering documents, DDQs, audited financial statements of the current fund or previous vintage as applicable, key policy documents, and key regulatory documents. You may notice here that it is not part of our standard process to send our own extensive DDQ for you to fill out and to return to us. This is because we find that the documents that you all have spent a lot of time developing are generally pretty good and answer many of the questions that we want answers to. So sending our own extensive DDQ just ends up being duplicative, and we're looking to be efficient through this process and minimize the strains on our relationships. Once we have reviewed the documents, we will compile a list of questions to ask during an on-site meeting. The on-site meeting can actually take place in person or virtually. and we like to meet with the senior level non-investment executives you see listed on this slide. This is our opportunity to ask deeper, more substantive questions that will inform us to how a manager thinks about and approaches their structure and operational risk. Therefore, we really do appreciate the opportunity to meet with these senior level executives where possible, since an ODD rating can come down to some of these higher level discussions. Next, we have what we like to call the trust but verify stage, where we try to verify as much of the information that we have collected through document review and on-site visit discussions with third parties as possible. This means reaching out to third-party service providers, confirming relationships, discussing processes at the third parties, and how the manager interacts with those third parties. We will reach out to service providers such as fund administrators, prime brokers, custodians, compliance consultants, valuation agents, IT providers, cybersecurity providers, and others. We have noticed that some third parties will not respond to us in our reach outs if we do not copy someone from the manager. While we understand the need or the desire for you all to stay on top of the process, we do highly value the independence of being able to reach out to a third party without chaperoning. Thus, during an ODD review, it can be helpful for you all to give the service providers a heads up that members of the ODD team may be contacting them. During this stage, we also run background checks on key individuals at the manager and on the investment management firm or GP entity itself. These focus on a review of publicly available documents and databases. A common question we receive is whether we ever pull hard or soft credit checks on the individuals, and I can assure you that we never do request those credit checks as part of our diligence. We don't really see the need, and that's personal information that we just don't need to have. Finally, we write an ODD memo that is typically presented alongside the investment due diligence memo at a meeting of the investment committee. Occasionally, we will reach out to managers to discuss our findings prior to bringing our memos to the investment committee. This will be based on our perceived severity of the findings or if the review is driven by a client request and whether the client wants us to reach out to discuss the findings with the manager. At the investment committee, we will discuss our findings and process and take questions from members of the investment committee. And as opposed to the 1 through 5 rating used by IDD that Nina mentioned, we recommend a rating of A, B, C, or F, which I will dive into in a little bit. Finally, I or my designee have veto power at the investment committee meetings, which extends beyond just the reviews that we perform, but I will also say we very rarely use it. From an ongoing monitoring perspective, we primarily conduct this through annual update calls with management of rated hedge fund managers or private markets managers, or by using Diligence Vault to survey all of NEPC's other hedge fund exposures that we inherited. These are geared towards identifying any changes at the manager and raising any concerns or updates with our mutual clients. Every 3 to 4 years, we repeat the initial ODD process that I just outlined from start to finish to re-underwrite the strategies on the hedge fund FPL. I mentioned that I would walk through the ratings. So we have, these are our 4 ratings. We have operationally acceptable, may not be suitable for all clients, suitable only for clients with a higher risk tolerance, and operationally deficient. I know there are a lot of type A individuals on this call and everybody's striving for that A rating, but I will say more often than not, we find enough issues during our reviews to bump most strategies down to a B. And this is where the majority of strategies are rated. There's a small handful of C's and an even smaller handful of F's. Getting back to the key initiatives that was started by Nina, a final initiative that we wanted to highlight is the new outbound investment rule. So we've done a review of the rule. We are aware of our responsibilities under this rule, feel that you all should also become aware of your responsibilities if you're not already. And since we diligence and recommend strategies to our clients, we've developed some tools to help us determine compliance with the rule. In particular, we have developed a questionnaire in Diligence Vault that we have been sending to managers as we review them. We're looking to receive certifications from managers that they will comply with the rule, and we cannot move forward with recommending a strategy to our clients without these certifications. We have recently decided to expand the group that will receive these questionnaires to any strategies that have or can have private investments in their portfolios. So more managers will likely receive these questionnaires in phases. And now I'll pass it back to Will to wrap us up.
Great. Thank you, everybody, for coming. Apologies for the technical difficulties. We had over 700 folks participate today, which is a sign of our partnership with the manager community. So we appreciate you guys coming through and participating on the webinar, and certainly look forward to doing this again next year. Thank you. Take care.